Hello, welcome. This is John Cato of 30 Minute Trading, and I just want to introduce you to loading indicators templates onto the chart here. Um, the whole point really is that you've got data, which is price action data, which is coming on a basis of some asset. In this case, it's the euro dollar and it's the daily chart. And you can see it moves around quite a lot. What you're trying to do is get a higher probability entry point to make a trade. And it's always going to be a speculation. You'll never actually know which way the market's going to move. So you're looking for something which is going to give you a clue. And my indicators, the 30-minute trading indicators, give you that clue. This is a default chart, so without anything else on it, that's what you'd get. Let's have a look at loading this one here, which is Swift MT Simple Black Daily. So I'm adding that one onto the chart, and I click on that and it loads it onto the chart. And now you can see we have a multi-time frame trend indicator, which also gives you average true range and what I call the IRR, the inherent risk reward ratio. And basically whenever it's green, it means you've got a higher probability on candle sizes of that or above. You can see daily the IRR is 92, which is quite high. However, you can also see that on the daily, the trend is down. So really you're going counter trend if you want to go long at the moment. However, the lower time frames are all green, which is saying that the trend for all the lower time frames is up. And we're looking like from an H1 upwards, then we are looking for longs. And the same for the BBBR. In fact, for the BBBR from H4, the trend is up. And this is all saying undecided. When it's amber, it's undecided. So let's look at the indicators themselves. Down the bottom, we have the bull bear butterfly, which is identifying the trend. And you can see in the data window, which I've got over here, which you click on this to switch it on and off. That's the crosshairs. Look at the data window down here to see what the values are, okay? And at the moment, if I hover over the final candle, you can see in the data window it's minus 13 on the bull bear butterfly, 2 on the litmus, 3 on the Swift trader, and 1 on the M trader. But the bar before here, you can see it's minus 14, minus 1, 0, and 1. The 1 means that the M trader has just switched from below to up. It's got a pulse of strength for going long. Now, the other things here, Litmus and Swift, are currently not showing long. So this is an early entry, counter trend, trying to go long. So you don't want to risk very much money on that, but you might want to risk a bit. And in fact, this is what I'm doing, is I'm trying the trade out. I recognize that it's not high probability, but there is some probability from it. Let's have a look at the charts and look at the indicators and bring a look on how they're set up. The two that we care about most are the M trader, which is the early entry, which is showing now, and Swift trader, which currently hasn't actually flagged over there. It looks it might do in the next close of bar. However, we go to this one, and when we look at this, what we end up with is alerts are set to true, cover alerts were set to true, show on chart is set to true, transition set to true. Okay. Now we don't mind about the rising volume. I'm saying that it's minus 14 to 14.75. I'm not worrying about the multi-time frames at all. They're all set to none. I'm saying litmus is set to counter trend and trend. I'm happy with that. I'm going for the wick in terms of the entry style, and an ATR 160 for the stop, and a 0.9% risk. So if I say OK to that, I'm happy. It's refreshed that chart, and we'll see if it's pulled up any trade alerts. And at the moment, I can't see any trade alerts coming up. So let's just see how that goes. For some reason, we don't have an alert kicking off. Let's have a look here onto MTrader. Now, it might be that we're so close to the 14, it won't recognize it. So I'm going to change that value to minus 14.75 to get the full range in. Leave the rest of it all as it is. Now, in theory, if I accept that and accept it, we should get a trade alert now. So we have the trade alert on the euro dollar down here, and it says buy 0.01 at 9859 with a stop at 9660 and various targets along here. Okay, so that's basically what we've got in there for the trade, and you can see that the trade I have on is put on down here with a take profit at 99563. Let's go back to the expert. 99563, 99998. So I'm somewhere between the two of those. Really, I should adjust that so that it comes correct to one of those. Now, what are you going to move to? What would you like to go for? The reason I put it there is because I've got this price action going up there, which is a resistance. So I want you to trade it up to the resistance. And I could go for anywhere of those, 9936, 9998. So let's just put a horizontal line on the chart at each of those prices. I'm going to put that on. The first one is 9936. So let's put 36 in there. And why not make it a dotted line so it doesn't get in the way too much, and draw it in the background. There. So that's one possible target, and that target is T1. T2 is 9998. So let's put another one on, somewhere up here, 9998, which is obviously going to be a more aggressive target, and that's actually at the resistance line. So you pays your money, it takes your choice. Okay, sort of, what do you want to do? Your choice, you're the trader. Do you want something that's closer or further away? Or do you want to be even less aggressive and go for T0? I've got a few other alerts coming up. Let's get back down to that one. So T0 is 9906. So what would happen if we went for that? Somewhere down here, 9906. Okay, so those are our target points. We've got one target there, one target there, one target there. Clearly, if it starts to move up, it's more likely to hit T0 than it is to T1, and it's more likely to hit T1 than it is to T2. The other point about trading is that you want to maximize your benefits if you can, because if you take the risk, stop 9660, let's put that on, 0.9660, and put that on. You can see the stop is all the way down there. So you want really to be targeting a bigger reward than your risk, all things being equal. Now you're balancing off the probability of hitting your closer target and winning versus losing. It's a trade-off. Let's take T5, 1.0260. 1.0260 T5. Okay, so you can see T5 is right up here, quite a long way away. You can see quite clearly with the way in which this price action might move or not move, as the case may be. To get all the way up there is quite a big ask, but that does give you the risk reward of from there to there. So that's roughly 3989 versus roughly 1734. So that's obviously a better relationship than this sort of relationship, which is much smaller. Well, you make a decision when you're trading what you're going to do. I've put my target here. I've got a feeling looking at this that I fancy this T1 target more, but that's a very tight target. I also am aware that when you set a bigger target and let the trade run, very often it can work in your favor. So you must decide in your demo account to try a number of different strategies. Here we've got a trade on. It says in this account, this is a live account, 0.01. What do I want to do? I think I'm going to go for T1 actually. So T1 is 0.9936. So all I need to do now is go to this trade and modify it so that this is going to be 9936. And there I put it on T1. Okay, and that says it's 845 pips. So we'll let that sit in that point. If I want to keep pushing it away, I can. The other alternative is I could make it big way out here and just leave it and not worry about it. And see if the trade would make it all the way. Or I could set the trade there to T2. Each trader will make their decision about what works better overall. You can see that for some of these trades over here, had I put a bigger target, it obviously would go for a long time without hitting it. Whereas if I'd got the bigger target here, that would have been beneficial. But that is such a big stretch, I'm going to stay with that. I hope that helps you with the thinking on it, and you can change any of these indicators to accommodate what trading style you want in terms of triggering the alert and also in terms of setting your target. It's entirely up to you. The other interesting thing actually I should advise you of is this Euro dollar daily on the AxiTrader site. Let me just come down to a lower time frame. You can see what I mean. If I bring it down, say the 15-minute time frame or the 30-minute, since it's 30-minute trade, let's click on that. Hover over that candle and you see it's 2030. Now it's 2030 server time. Real time here is 5 minutes to 7 in the UK. So that 2030, if I come down to the 1 minute, for example, you can see the time there is 2055. All right, so that is 2 hours ahead of where I am in the UK. Why is that important to know? Let's go back to the daily chart. Have a look at this candle structure and the alert triggered here. I'm now going to show you another trading account that operates on the UK time. Think about those candles and look at this structure and this alert generated on mTrader. Click over to here. There is no alert on mTrader. That alert came out earlier there on that candle because that is trading on UK time. This candle structure is now different completely. So even though you think a daily candle is a daily candle, it's not a daily candle. It's a day depending on the server. And therefore, any testing or exploring you do around this subject must be done on the basis of the server that you're using and be consistent about understanding that time frame. And actually, that's one of the reasons why I quite like the 30-minute time frame, is because this 30-minute time frame, this candle structure there, have a look at that. If I cut back to the other chart and pull that in and go to the 30-minute, you'll see that the candle structure is identical. I go back. There it is. It's the same. So when you're down at a 30-minute level, it's the same. And 30 minutes is, and below, it's always going to be the same structure. Over 30 minutes, not necessarily so, because there are some that are not aligned even with the hour. So 30-minute trading is more consistent candle structure, more consistent for backtesting, more consistent for exploring. But if you want to do daily, and there's some evidence to suggest that daily trading is more profitable and more consistent, backtesting on a daily candle can give you better results. The question is, why is that? The answer is that at the smaller time frames, there's a lot more noise in the market, and therefore it could be argued less certainty about the direction that the market is moving. Anyway, that's enough to tell you right now. Wishing you well. This is John Cato, 30-Minute Trading, and happy trading.